Hey guys, I am Jatin Verma. This is part 2 of Yojana analysis for the month of August 2017. Guys, in part 1, we talked about the conceptual things like input tax credit, like what is destination based tax and what is your cascading effect. So now, having dealt with the conceptual things in part 1, here we are going to talk about a bit of factual details as well as conceptual details. Here we are basically going to talk about the transitional challenges ahead, because in countries like Canada, Australia and Japan, there after the implementation of GST, they had witnessed a lot of inflation. Now the point is our country with 28% of its population below the line of poverty, below the so-called poverty line, are we ready to cope up with high inflation regime? So we are going to talk about these things. Then we are going to deal with the federalism aspect of the GST. So let's proceed ahead. All these things were taken care of in the part 1. Here we saw the cascading effect. A bit of recap I am giving you so that you guys are better able to connect with. Now smart governance, GST is smart governance based model. Then journey to the launch of GST, again factual details. France was the first country. Then why a constitutional amendment was needed, because under our constitution, taxes were divided between the center on the one hand and the states on the other hand. Then structure of GST council, then this layers of tiers of taxation system. Goods were compartmentalized into these rates of taxation, 0% to ranging between 0% to 28%. Then profiteering, again a conceptual thing. What is anti-profiteering authority? We saw with the help of this tea packets example. Now coming to this overzealous administration thing, that is anti-profiteering provisions. Are these anti-profiteering provisions, are they going to lead to an overzealous tax administration? So we saw that no, it is not going to, because a sunset clause has been inserted into the anti-profiteering provisions. So wherein after the expiry of 2 years, these provisions will be eclipsed by the overall GST law. Now coming to the aspect, the GST, this National Anti-Profiteering Authority is going to follow a formula-based approach. When I say formula-based approach, that basically means that in the pre-GST era, whatever, suppose if a commodity was selling for 100 rupees, 105 rupees in the pre-GST era, the same commodity maintaining the same margin of profit for the retailer, it will be the endeavor of NAPA to see that no producer, manufacturer, retailer or wholesaler is able to derive super normal profit after the implementation of GST. So a kind of profit parity will be maintained. So the profit that the producer or the retailer was earning before the implementation of GST will be ascertained, and then after the implementation of GST, similar margin of profit in the percentage terms will be maintained for the producer, and there will be no victimization of the producer and no overcharging from the consumer this way, because profits, their prices will be ascertained, the post pre GST era and the post GST era. Whatever the price of a commodity was, including the profit for the retailer before the implementation of GST, that profit margin will be maintained, right? So this is the formula based approach that this GST network, National Anti-Profiteering Authority is going to follow. So how is it relevant for us? Because if at all a question comes that GST has led to overzealous tax administration, the inspector Raj or the license Raj kind of thing, you can cite this that a formula based approach has been followed by the government. And why this anti-profiteering clauses are required? By the experiences of some countries that have adopted the GST, such as Singapore and Malaysia. They saw a surge in inflation, an increase in the uptick in the inflation after these countries implemented GST. So that is why, taking a precautionary approach, government is cognizant of the matter that these retailers, they might indulge in profiteering, that is charging over profit, charging over price by citing the GST as the reason to the customer. Now coming to the other thing, features of GST. Now having understood the nitty-gritty, the conceptual things, it will be a cakewalk for us to tread through these points. GST is applicable on supply of goods. That is why it is a destination based tax. Those of you who haven't yet watched the part 1 of this Yojana magazine, I would request them to watch the part 1, because all these technical terms, destination based tax, consumption tax, all these have been dealt with in the part 1. Now import of goods is treated as interstate supplies. Import of good, that means the goods that are imported from other countries, be it from Saudi Arabia, be it from USA, they will be treated as interstate supplies and would be subject to IGST, interstate GST, integrated GST you can say. Then import of services is treated as interstate supplies and would be subject to IGST on reverse charge basis. Now what is reverse charge basis? See, when a producer, when somebody imports a good, or when somebody takes the services of some company like shipping company, these are services because shipping company of some country is you can say providing you the transport service only. You are not importing any good. So in that sense, if the some transport agent in country A is there and shipping company of USA is there, so this ship was chartered for transporting goods to Kandla Port of India by the agent A. Now agent A, as the goods that are being transported, they belong to you can say some Pierce company or some any other soap company. So that Pierce, it imported certain raw material for manufacturing of these luxury soaps or any kind of soap. So now they do what? They have imported. Now in this case, who is paying the you can say the charges to the shipping company? In the immediate incident, it is the agent of the company or Pierce who is paying the charge. You can say the service charge to the transporter, shipping company. Now A will be paying the tax, service tax in this case. But in the case of reverse charge basis, what happens is the Pierce, that is the consumer, will be paying the charge for the service tax for the charges being paid to the shipping company of USA, because USA's company's registered office is in USA. So USA's company is not liable to pay taxes in India. They are required to pay taxes wherever they are registered. Say, suppose take the example of Amazon. Amazon is delivering you the service, you can say the goods and services, okay, the products. Now if it starts charging some kind of if it is providing some kind of services, then customer is liable to pay service tax on this. Okay, so when customer is paying the service tax, that means it is called reverse charge basis, because ultimately earlier the charge was on the agent A of the Pierce company. Now if this charge is being met by the consumer, the ultimate consumer, that is called reverse charge basis. I hope it is clear. Then CGST, Central GST, State GST, UT GST and IGST is levied at rates mutually agreed upon by the center and the states. So it is not that center is being acting in a unitary manner. It is a consensus based approach followed under the aegis of Goods and Services Tax Council. So GST Council is a constitutional body. There are 4 tax slabs, namely 5% if we ignore the 0, 5%, 12%, 18 and 28%, and if we ignore the cess also, if we include them, then it becomes 6 slab rates apart from the tax on jewelry and diamonds. So these are the 6 tax rates, including the 0% tax slab and the 28% plus cess as a tax, you can say. Otherwise there are in a vanilla based approach, there are just 4 tax rates, tax slabs. Now coming back to the same slide, here we were talking the precious metals would be subject to a tax rate of 3%. So if you are importing gold or jewelry or something, 10% customs duty will be levied plus 3% GST will be levied on raw diamond, or you can say on the gold. And then when jewelry is this precious metals, they are processed into this jewelry, then 3% GST will be levied. Only on import 10% of customs duty will be levied, and on the raw diamond stones only 0.25% will be levied as a kind of GST. Goods and services tax. Some specified goods or services have been exempted. For example, the goods being used by the common people, the disadvantaged sections of the society, the so-called poor people of the society. Now GST covers the entire gamut of goods and services except alcohol meant for human consumption only. Alcohol meant for medicinal purposes is covered under the GST. You should not get confused regarding this, which is constitutionally out of GST. So alcohol for human consumption is constitutionally out of GST. Apart from alcohol, these 5 petroleum products, crude oil means raw oil as is extracted from the earth, then petrol, diesel, ATF means air turbine fuel, then natural gas are out of GST, not constitutionally, only legally. So that basically the difference between constitutionality and legality means that as and when the GST Council feels comfortable, all the states are comfortable with the inclusion of these 5 petroleum products into the GST arena, then they can do so without any constitutional amendment. But for alcohol for human consumption, you need a constitutional amendment and can be brought into the GST fold on the recommendation. Now, a common threshold exemption of rupees 20 lakh, that is 10 lakh for special category states as specified under Article 279A of the Constitution, except the state of Jammu and Kashmir. For both CGST, SGST has been provided for. So, common threshold exemption basically means that if a producer or a seller or a retailer is having a turnover of just 20 lakh rupees. Turnover basically means the sales. Sales means the daily collection and then the monthly collection and then annual collection. So out of sales, if you mention the if you subtract the cost of goods being sold, it gives you the profit. Here we are not talking about the profit. We are talking about turnover. Turnover in simple language means sales. So if a producer or a retailer or any enterprise is having a sale of less than 20 lakh rupees, he or she is not subject to this thing, GST, right? If the sale increases the 20 lakh threshold, then GST will be applicable. Now guys, this point requires your attention here. Besides this generally applicable exemption limit of rupees 20 lakhs, so this limit is generally applicable to almost all the enterprises, but for small enterprises not complying with the paperwork, not having the paraphernalia like computer machine or billing machine, or not able to hire the chartered accountants, there is an option to pay tax at a flat rate without getting the input tax credit. So input tax credit, who gets the input tax credit? A dealer like Haldiram Sweets, you must be knowing about this chain stores. So they do what? They procure wheat flour or other kind of raw material, sugars in tons and tons of quantities. So they may be seeking the input, from the sugar vendor from whom they are purchasing the sugar. They may seek a bill. But consider the case of a nearby grocery store. He may not be having the paraphernalia, he may not be having the resources to hire a chartered accountant in order to comply with the legal requirements required for Haldirams to claim the input tax credit. Input tax credit basically means the sugar mill first of all would have converted the sugar cane into the sugar. I'm just discussing it in a layman's manner. So then sugar has been converted. On this stage, some tax must have been paid. So now this sugar is being used as input by the Haldiram sweet shop, these dealers, manufacturer. So this sweet shop vendor, he must have used sugar, maida and other such raw material while manufacturing the final products called sweets, barfi or any other thing, right? So they would seek the tax already paid by the sugar mill. Sugar mill can provide them the bills, but consider the case of a grocery store who is selling whose unit is around 1 kg or 2 kg to the nearby residents of the locality. So he may not be able to install that vending machine and bill generation machine or computer, etc. We are not talking about supermarkets. So for those normal small traders, this special provision is there. Government is offering them an incentive that they can pay only 1% tax. This tax rate of 1% is for the manufacturers under the composition scheme, and 2.5% for restaurant sector. So restaurant sector has also been included under the composition scheme, because in restaurant sector so many raw materials are such that they do not get the bills for the raw materials. Suppose if the restaurant owner is going to purchase the vegetables in the morning, he may seek a bill from the commission agent who is selling the vegetables, onion, etc. But he may not get the bill. So that is why government says the minimum tax rate under GST is 5%. If we come above the 0% rate, then 5%. But here we are seeing that these manufacturers or restaurants owner, they are given a special incentive that they need to pay tax only at the rate of 2.5%. Why? Because there is no provision for getting the tax credit for inputs that they have used. So that means even if the government is charging 5% rate from the normal vendors who fall in this category, 20 lakh category, even if the government is charging prima facie charging 5% as the tax rate, but after refunding and all, after paying for the salaries of the taxmen, after paying the administration charges for collection of the taxes to salaries to banks, etc., commissions to the salaries to the tax officers, the government is effectively getting around 2 to 2.5% from every vendor. So that is why in their case, under the composition scheme, those vendors who are having an income, you can say the sales less than 75 lakh rupees, they are already being charged with that 2.5% or 1% rate of tax, because thereby government is also being relieved of the paperwork or the formalities, and government is getting a flat rate of 1%, wherein no refunds would be there, no time would be taken of the government machinery in refunding the taxes. Do composition dealers have the option to avail input tax credit? Input tax basically means tax paid on the inputs that are used as raw materials in the manufacturing of goods. So in part 1 we saw this input tax credit in Pier's example, Pier soap manufacturing example, caustic soda and all. Now, no, composition dealer is not allowed to avail input tax credit of GST paid to their supplier. Can composition dealers issue tax invoice? So they are not required, they are not allowed rather to issue tax invoices. No, since a composition dealer is not allowed to avail input tax credit, such a dealer cannot issue tax invoice. So what is a tax invoice? Basically, tax invoice details this is the price of the good, rupees 200, and then this is the tax GST levied at the rate of 12%. Okay, so this tax invoice shows that you have paid the bill on this 200 rupees, your tax on this 200 rupees amounting to rupees 24. So the person who is purchasing sugar or anything for these 224 rupees, while paying the tax again after processing sugar and other things into sweets, he will be required to pay tax on 500 rupees at the rate of again 12%. So then this somewhere around 54 rupees you can say, or 58 rupees, whatever this tax amount. So out of 56 rupees the tax amount on 500 rupees, he will be required to pay a tax of he can deduct the tax of 24 rupees already paid. But in case the input tax invoice is not there, bill is not there, then you cannot claim the tax. So people, the enterprises, the small enterprises which are dealing with the regular customers, you can say the customers which buy small quantities of any goods, okay, retail traders, the nearby grocery stores, they need not file their return according to the 5% tax rate. They need not give tax at the rate of 5% or 12%. They can opt for the composition scheme, provided their overall sale is less than rupees 75 lakh rupees in an year, right? Now coming to GST network, creating a strong IT backbone. GST envisages credit of input tax credit of 80 lakh taxpayers to be processed within 10 days after filing of monthly returns. Suppose if the monthly return is filed on 30th of July, then by 10th of August you have to refund the tax, process the tax transactions. So this entire burden will fall on this IT backbone created under Goods and Services Tax Network, which is expected to contain 2.6 to 3 billion business to business invoice data. So what is business to business invoice data? Here we saw the example of input tax credit. Suppose if the local vendor who is selling sugar, if he gives the invoice, then this invoice will be uploaded by Haldiram's that yes, I have bought 200 tons of sugar from this person, and this person has already paid tax amounting to rupees 240 rupees. Okay, so while paying the final tax of 56 lakh rupees, this 12% tax already paid on you can say 200 rupees will be deducted. So both these entities, they will have to record their business to business invoice data. Okay, so this is the way to go about it, and GST network is going to process so many transactions in a span of 10, 20 or 15 days. The IT backbone has come up in the form of GST system consisting of GST portal. So GST website is there and IT platform. So wherein you have got the option to pay tax through your credit card or debit card also. The GST network has successfully developed a common GST portal that acts as a one-stop shop for all businesses. Now have a look at this image. See, states will also be integrated on this GST network website. Okay, consider this is the GST network website, or you can have a look here directly. So this is the GST Suvidha portal, GST Suvidha facilitation counter or website. Taxpayer is uploading the documents. then he is able to download the tax challan, that proof that he has paid the tax. So uploading and downloading by the taxpayer will be enabled. Then taxpayer will also be able to register himself. He will be able to download the challan forms that attesting to the fact that he has paid the tax. Challan generation will also be possible through this single website, one-stop solution. Uploading the document, invoice uploading, the bills are uploaded onto this platform. Then return, income tax return, GST return is to be uploaded on this same platform. Then ledger, etc. Then this GST platform also contains web portal. This is the desktop or laptop enabled web portal. Then mobile application is also there. Accounting package to make this taxman's practices compliant with the requirement of GST. This accounting package is inbuilt into the portal itself. Then ERPs, then custom apps are there. Then this is the first layer. Okay, this entire layer is the first layer. Customer is not provided the access directly to the you can say GST server. So this is a kind of gap in between, and this data is then fed by this GST Suvidha portal into your GST server, and then GST server is then finally accessed by the ministries of the state finance ministries, state governments, as well as the central government, right? Then here functions of GST network. So in the previous slides it was in the text form. Here we are seeing it in the diagram form so as to make it easy for us to remember. So what are the core functions, core services? Registrations, as we saw. Returns will be generated that yes, this this vendor has paid the tax. Then payments will be processed through debit card or credit card, or if the person is not tax savvy, then he can pay the tax due to him in the bank branch nearby, and thereby feed in the challan numbers. In the similar manner, when you do for your application forms for government jobs, before this internet was there, application was there, what we used to do was we used to apply, we used to pay the fee in the bank and then fill the details of the payment slip onto the website. So this is also an option here. Help desk support will be there. Information on interstate supply and cross-section utilization. Then this is common and shared IT infrastructure. Then autonomy of backend system and states. So this is also their approval of registration, assessment, approval of registration of taxpayers, the assessees. Then assessment of the taxpayers. Then refunds due in the next 10 days or so. Audit and enforcement. So auditing will also be there. Adjudication, in case somebody is having any grievance as to non-refunding of the tax or levying of any penalty, adjudication mechanism will also be, details will also be uploaded on this function. Then these are non-statutory functions. These are the functions which are not inserted in the law, GST Network Act that has been enacted. Okay, so these functions are statutory functions. Then recovery, etc., internal workflows to support the above functions, then recovery, analytics and BI, etc. Right, so these are the details. IT interface will be there between business and processes. This is the cutting edge level, so wherein the customer will be interacting with the GST network, and this IT interface, like we saw here, this is the IT interface being provided by the GST network. So at the first end, customer is interacting with this GST Suvidha portal through web portal, and then these details are integrated, this interface is there in order to feed these details into GST server. Then GST has been, how it works, GST has been designed to work as a one-stop shop for all indirect tax stakeholders, providing services like you can say common registration, creation of challan for payment. This is the repetition only. Then what are the facilitatory steps? 34 GST Suvidha providers have been appointed. So these providers are on the same lines that we see in case of Aadhaar card enrollment. You know, some private entities, they have been appointed, and even the banks like SBI, PNB, etc., they are also acting as GST facilitation providers, facility providers. Payment of taxes has also started taking place using one form for all types of taxes. Earlier there used to be multiple forms, thereby creating confusions in the minds of the taxpayers. Now the other slide, challenges before GSTN, integrating 36 disparate systems. So before the implementation of GST, different states were having different tax rates. Now all the different tax systems, they have been integrated. So these were the challenges that GSTN has successfully overcome. GSTN is a non-constitutional body. It is unique as it seeks for the first time to establish a uniform interface for the taxpayer and a common and shared IT infrastructure between the center and states. So this is what enables the interstate refund of the interstate taxes being paid by a customer. Suppose, for example, coming to this map of India, suppose a person sitting in Karnataka, okay, he has paid the tax on the raw material that is further being processed in the state of Tamil Nadu, or for that matter in the state of Sikkim, Assam, Arunachal Pradesh, Meghalaya, or for that matter in the state of Gujarat, Rajasthan, anywhere in India, okay, Bihar also, Chhattisgarh, Odisha. All these details, claiming the refund of the tax already paid in state A will be possible sitting here in state B because of this GST network. Right, earlier it was not possible. So if the state tax paid on the goods manufactured in state of Rajasthan, if these goods are further being processed and are being used as raw material in the state of Maharashtra, then the tax that has been paid on in the state of Rajasthan cannot be claimed back. Now it is possible. Now coming to GST network again. I hope it is getting clear to you. Else please cite in the comment section what are the if you are having any kind of doubt with respect to concepts only. Okay, on the broader level, you have to understand this composition tax scheme, input tax credit. So because UPSC and other exams also, banking exam also, even SSC also, they are asking concept based questions. They are no longer asking the factual details. Even though a little bit of factual details, the structure brings flexibility, you can say, of the private sector while ensuring that strategic control remains with the government. How the flexibility is being injected into this system? See, the government of India and state governments came together to create the Goods and Services Tax Network. It is a special purpose vehicle. It has been registered as a non-government, not-for-profit company, incorporated under Section 25 of the Companies Act 1956, where the central government holds 24.5% of the shares, and all states collectively, 29 states of India and UTs, they hold 24.5% of the shares. So the total shareholding of the government is 49%. Then the remaining 51% shares are held by private financial institutions. HDFC 10%, HDFC home loan major owns 10%. Then HDFC separately 10%, home loan subsidiary of HDFC another 10%. LIC Housing Finance define the trend holds 11%. So that is why in the bold letters, in order for you to remember it, right? ICICI Bank owns 10%. Then NSE, National Stock Exchange Strategic Corporation Limited, owns another 10%. So 51% of the shareholding is by private entities. Let's do a bit of critical analysis. See guys, this GST network is going to perform critically important national functions of the sovereign nature, that is legitimately the domain of governments. But the shareholding 51%, majority of the shares are being held by these private entities. So that is why critics say that it is worth noting that some of these entities are controlled to the extent of 75% by foreign institutional investors. So first fact is that they are themselves the private entities. Okay, another glaring fact is that the major share in these banks, HDFC's own shares, 51% of the HDFC equity is held by the foreign institutional investors. So that is why before the you can say the launch of GST, implementation of GST in our country, Ministry of Home Affairs conducted a background check of the management of HDFC Bank, HDFC Life Home Loan Major, then ICICI, etc. This structure brings flexibility, though this is an advantage, but at the same time, sovereign functions being performed by an entity in which large part of shares, majority of the shares are being held by foreign entities, foreign institutional investors, is something to be looked suspiciously, something to be wary of at all the times, right? Then another silly fact here, that this GST network has been developed in collaboration with Infosys. So don't get confused with Wipro, TCS, etc. It is Infosys over here. Then rest of the details have been taken care of. Now coming to another thing, benefits or side effects for the consumer of GST for the consumer, a balance sheet. Coming to the summarization part, there are two different ways in which GST can have impact on the consumers. Firstly, The direct and immediate impact of GST will be new effective tax rate on each of the goods and services. Depending upon how the new effective tax rates are as compared to the pre-GST period, the prices will increase or decrease accordingly. So it is a wait and watch kind of thing over here. Secondly, an indirect impact of GST which is likely to be visible only in the medium to long term can come through changes in the production and supply chain processes. So what this line is basically saying that now the production and supply chain processes, entire, you can say majorly, the automobile industry of India is concentrated in the city of Chennai because of the tax advantage and because of the advantage of the port city, that is Chennai. Okay, because it makes them easier to transport goods further on to Southeast Asian countries via this port. So that is why these are the supply chains and manufacturing chains have been designed on the basis of tax advantage, tax arbitrage. What is tax arbitrage? Suppose in the state of Punjab, Haryana, Rajasthan, if the tax is 12 to 15% on the manufacturing of cars in the state of Rajasthan, and in the nearby neighboring state of Madhya Pradesh, the tax on the manufacturing of cars is 10%. Then the manufacturer company, be it Tata Nano or be it your Mahindra and Mahindra or be it BMW, they will take the decision on the basis of lower tax rate. So they will set up their plant in the state of Madhya Pradesh. Okay, this is called tax arbitrage. Now with the coming up of GST, there is a universal tax. That is why we say, even though there is no one tax, there are 5 to 6 different rates of taxes, but universal tax rate system is there across India. Even if you set up your plant in Tamil Nadu, in Jammu and Kashmir, or Tamil Nadu in Kanyakumari, or even in Nagaland, or for that matter even in Porbandar in Gujarat, tax rate on the manufacturing of cars would be the same. So these kind of decisions now will lead to reorientation, re-establishment or alignment of these factory or other kind of enterprises, right? So this is there. Now coming to the same point, this now come through production and supply chain processes. So these are the kind of changes that we can see 2 to 5 years down the line. Then thirdly, another way in which the effective tax rate can change is through input tax credit scheme. So we have already seen that in part 1 of this analysis, through input tax, because input tax credit will be available even if one part of the one component of the car is manufactured in Jammu and Kashmir and it is being used for manufacturing the final product, that is the ready to drive car in Tamil Nadu. Even then also input tax credit will be available. So the producer of car spare parts sitting in Jammu and Kashmir, having its factory in Jammu and Kashmir, need not relocate to Tamil Nadu for the sake of synergies between the industries. Now negative aspects. Experiences from other countries such as Japan, Australia, Canada and others show that there was an increase in the inflation post GST implementation, and the same situation can arise in India as well. So can the situation arise in India or not? How can we judge? It all depends upon how many entities out of the total entities, what was the extent of formalization, in the sense that how many entities were already conducting their business in the white. To use this word, white basically means, were they issuing the bills earlier? Were they paying the tax earlier to the government? If at all they were paying the tax earlier, then there will be negligible impact of the GST system. If larger part, let's say 75% of our economy was outside the ambit of GST, then we might see an increase in the taxation. Currently, a disproportionately large number of business entities in India operate on informal basis. That is what I have highlighted. You can fill in the blanks over here, complete this sentence. Operate in the informal sector. Now balancing, this is very important part of it. Analytical, relevant for all the 3 stages, prelims, mains as well as interview. The problem with GST is that tax, like all taxes, is dependent on the economy doing well. So if the economy is booming, tax revenue, government will be able to garner better tax revenue. Already the tax to GDP ratio in India is around 10% to 11%, between 10 to 11%. Now it could see an increase up to 16%. So GST should broaden the tax base, because as I said, these informal sector players like nearby grocery store or any such players, they would now be brought into the ambit of GST. However, whether this would be achieved would depend upon the next year or so. What are the prerequisites for this to happen? Government and industry have to manage to work in tandem to smoothen out the, iron out the differences over the overall transactions and rate of compliance. Now, what are the vulnerabilities on the way? States face an ever-increasing cost curve. So that means with the implementation of 7th Pay Commission report, that pay or the salary of the government employees in all the states, they have the salaries have increased. That is why state governments, all the state governments' revenues are under stress. Now, their wage bills are expected to go up considerably. A rush to write off farm loans. Another trend that is being witnessed is many states, including Uttar Pradesh, Punjab, etc., they are writing off the farm loans, due to which again their cost curve is, their expenses are under strain. Then UP has till now seen 3 state governments agreeing to write off loans, including Uttar Pradesh. India's public debt. So public debt basically means the debt which the government, the loan which the government has borrowed from the public via government securities, etc., which is the sum total of central and state debt as a percentage of GDP, already stands at 67%. So this is if our GDP is $2 trillion, 67% of $2 trillion is due to the other countries, okay, including World Bank, etc. And this is the highest among major Asian economies. So we are one of the highest debt laden country. We have to pay a huge debt when compared with other major Asian economies except for Japan. So was this the right time for implementation of GST? Because government is essentially taking a risk that if the revenue generation out of tax collection of the government of India goes down, or for that matter all the state governments in the India, it goes down, then from where will be able to service this debt? From where will be pay the interest due on this debt? This time round, if all states were to write off the farm loans and pay for this act by taking fresh loans, their new debt would amount to rupees 3 lakh crores. So these are the vulnerabilities. And Uday scheme also for the relief of distribution companies, power sector companies. The gross fiscal deficit to GDP ratio in 2015-16 has already breached. So this is the ideal mark, you can say. 1:2. Gross fiscal deficit, that is the case when the revenues of the when the expenditure of the government is increasing the GDP. Okay, so fiscal deficit as a part of GDP is or has already breached 3% ceiling, considered fiscally prudent for the first time since 2004-5, right? So this ceiling is considered fiscally you can say prudent. We can feel comfortable when we are under when our fiscal deficit is under 3%, but we have already breached it in the year 2015-2016. So again, if due to implementation of GST, government's revenues they see a fall, then we might well exceed 3.5% level of the fiscal deficit. Fiscal deficit is when the government's expenditure is more than the government's revenue, including both the capital expenditure as well as the revenue expenditure. Under these circumstances, the inability of the state's demand for cash to pay for wages, development expenses basically means a payment of school children fee or teachers fee, then welfare expenses, etc. And the loan waivers they are announcing may see the states going on the war path against the center. Now, away from the ideal GST. Why is it away from the ideal GST? Because 45% of the indirect tax revenue, I'm talking about the source of revenue, are not covered by GST. Petroleum, crude oil, liquor meant for human consumption, these things are, even the land revenue taxes are not covered. Real estate is not covered. So real estate, it you can say subsumes in itself a lot of black money. So when that is not covered, that means 45% is not covered. Real estate, petroleum products, alcoholic beverages, and states will have the ultimate right to tax them. The GST bill, even though the GST bill promises that in time GST Council will be able to arrive at a consensus and will move these items into the GST fold. However, it is more likely that down the lane states will realize that it is proving to be disadvantageous for GST is proving to be disadvantageous for them. So they may not surrender their autonomy with respect to taxation of items like real estate, petroleum, etc. States for now have complete autonomy. This, coupled with the need to build a financial cushion, will possibly see the states working actively to retain these items of taxation. So whatever has been surrendered to GST has been surrendered. Okay, so we may not be able to see any more surrendering of financial powers by the states to this GST Council. Now, in the Constituent Assembly debates also, this issue had arisen when the issue of division of financial powers between the Union and provinces came up in the Constituent Assembly. Many members of Parliament had argued in favor of giving more powers to the states. However, the fear of excessive federalism was cogently argued as being against the spirit of One India, and the framework which thus came out tended to focus legislative and executive powers with the center rather than with the states. So there was debate. This issue was already discussed in this state. Now, should states have relinquished all their taxation? Should states have surrendered all their powers, taxation powers in favor of GST? Problems unique to states? No, they should not have, because India is such a diverse country. Bihar may not be having the similar problems as Punjab is having, and Punjab may not be having the same problems as Haryana is having. Once a brethren state, okay. Once a part of Punjab itself, now a brethren state, that Haryana might be having its own set of problems. So in order to deal with their own set of unique problems, states need some own finances for themselves. Observers point out that if states were to give away their freedom to increase taxes in respect of at least some goods, their ability to raise resources to address problems unique to them would be compromised. Now, some states are having unique welfare agenda. Consider the case of state of Tamil Nadu. Their PDS is considered to be the best in India. Many studies have been conducted and they have found that the southern state of Tamil Nadu has done remarkably well in its social parameters because of Amma canteens, because of various other welfare programs. Okay, and you can say social parameters are comparable to that of group of OECD countries, Organization for Economic Cooperation and Development countries. So that is why states should not have, and they haven't yet you can say surrendered all their financial autonomy. Now, another important topic, GST and transfer of taxation powers from the elected body to an unelected body. Is it a matter of concern for accountability? Legally speaking, the GST Amendment Act effectively transfers the power of taxation over the large swathes of possible taxation to an unelected body. Effectively, GST Council set up by the Act takes on the powers of deciding tax rates from both the Parliament and the state legislatures, and these have to be implemented across the country. The Council will now be the supreme legislative body in determining tax rates on all goods and services through the length and breadth of the country, and not the directly or indirectly elected members. So earlier what was happening, consider the case of this legislative assembly of any state of India. Earlier, the finance minister of the state was answerable to the MPs, MLAs of the state, opposition parties. Okay, so when he used to present the budget, he used to decide the taxes depending upon the conditions prevailing in the state. Suppose if some agriculture dominated state, the policies will be taxation policies will favor the agriculture related products. Spare parts of tractors, etc., would be taxed at a lower rate. Tube well repair, submersible, etc., all these fertilizer, etc., may not be taxed at all. Whereas in the case of manufacturing state, these items would be taxed, you can say normally, without giving any special concession. So now the finance minister may not be, as the finance minister has lost you can say delegated the power, or you can say he has shed his power to the GST Council. So he may not be able to decide the matters of taxation favoring a particular sector of the state economy, or you can say incentivizing the sector of a particular economy. These matters he has lost control over, and this control has been given to GST Council. So that is why a kind of you can say accountability of the elected minister towards the population of the state has got deteriorated in the process. The GST will now be the supreme legislature, even though this is an elected body of elected MLAs of the state who are appointed as the ministers in the state, and MP in the form of member of parliament in the form of Honorable Finance Minister of India. So they are elected representatives only, but the accountability seems to be suffering over here, as I explained to you through this example of state legislative assembly. Now, this thing is there, or indirectly elected members of the parliament and state legislature. Earlier, this finance minister and the government was accountable to the elected representatives. In a sense, this will be like an educated super body elected by electors without any direct responsibility to the citizens voter. How? Because earlier all these MLAs, they used to question the state finance minister. Okay, and this they in turn, when they used to go, these MLAs, they used to go to their own constituencies. They can tell the people that yes, we questioned, we get out the state finance minister on this particular issue. But now, what face would they put up towards their voters when they go on a visit to their constituency? State would also like to retain some powers of taxation, as the passage of GST places them in some ways at a disadvantage with respect to subordinate bodies. Now, this is another issue, that municipal corporations, especially like Municipal Corporation Delhi and Bombay Municipal Corporation, they, what is happening there? Their own budget is between 10,000 crore to 40,000 crore, 30,000 crore rupees. So states have relinquished their authority to the larger body called GST Council, the national level body, but municipalities are having their powers intact. Okay, they need not depend upon the state government, so which have now more powers to increase the quantum of taxes. So municipal bodies like Mumbai and Delhi, as I gave you example of, they have the power to increase or reduce their taxes according to the demand of the local populace, according to the demand of the citizen voters. But MLAs may not be able to respond to the demands of the citizen voters accordingly. Then entry tax by municipal bodies, they are still the source of revenue. Then entertainment tax in the big municipal corporation towns like Mumbai, Delhi, Bengaluru, Chennai. Entertainment tax is a source of revenue for local bodies only. Stamp duties on the registration of property, etc., they all go towards the revenues of local bodies. Products such as alcohol and fuels are also taxed in those, even the electricity. Then real estate tax, you can say the property tax, also goes towards the revenues of municipal corporations. Still are not covered by these electricity cess levied on the supply of electricity on the electricity bill is not covered under GST. This gives them the right to increase or decrease these taxes as per the demand of the population, thus build greater financial independence from the state governments. So they may not be asking too much from the state government nowadays after the implementation of GST. While the reverse would be the case for the states, which would be bound by the decisions of GST Council, the national level body headed by Finance Minister. Even though the voting share is there, but still, it would do well to remember that in most countries where deferral authorities or the GST council like authorities were there, deferral authorities, GST council type authorities had the right to determine the indirect taxes. Indirect taxes basically means taxes on goods and services, and enjoy the right to raise them. Provinces, the state governments have the right to direct taxes. The income tax goes towards the state government. Okay, so it is legitimate also. If you see all these issues of policing, it is in the domain of the state government. According to the 7th schedule of the constitution, article 245 says that these topics like health, subjects like health, policing, education, these are in the domain of the state governments. So likewise, income tax generated from the person, you can say this citizen of state A, should go towards the government A revenues of the state. But it is not the case in India. But in other countries where GST was implemented, deferral authorities or GST council type authorities, they had the authority to tax the indirect, get the indirect tax revenues. But direct taxes were handed over to the state governments because they were more closer to the ground, to the citizen. So that is why income tax is best collected and retained at the level of the state government. But here in India, this is not the case. The provinces have the power over direct taxes, while federal government, that is the union or the central government, has the power to tax indirect taxes, which is why the change over to GST did not entail any impact on the state's power in those countries, or at least the state's revenues. But in India, however, the center not only enjoys the sole rights over direct taxes. You talk about this tax, income tax, it goes towards central government only. Corporation tax, again central government, a portion of which it may give to states, but it also now enjoys the exclusive right to nearly half of the GST proceeds. Why half? Because 50% of the revenues would go towards the central government alone. Then it is yet to be seen how the Indian polity will respond to the challenge to the eventual implementation of goods and services tax. It would well accept the taxation powers which have now evolved or chafe at the bit and seek a change from the new status quo. In case the states eventually decide to seek fiscal arrangement which is less straight-jacketed, which is universally applicable here. Presently, what has happened is same tax rate has been universally applied to across all states of India. But in case in the times to come, because today it is effectively one party rule, one party, that is BJP, is ruling almost all the states of India. So that is why now at least it is possible for now to have a straight jacketed formula, one size fits all approach towards the taxation. But in the times to come, this may not be the case. They could then, during those times when coalition governments would be there, or when the different governments of different parties would be there in different states, they could then either choose the Australian model, where 75% of all taxes are raised by the union government or the Commonwealth government and distributed through a very sophisticated mechanism similar to that established. Okay, so a sophisticated mechanism is there. Suppose if we were to apply the same mechanism in India, Bihar being a backward state, it will be given more revenue out of the overall 75% revenues allocated to the states of India. Now these are the rates. Canada model is also there. Okay, through a very sophisticated model, these grants are distributed. And then this would be now Canada, where the GST was introduced in the last century. Provinces have the right to direct taxes. So we could either go for this Canada model, where provinces, the state governments, they implement they collect the tax revenues from income tax, etc. Or we can have the Australian model in our country, when states would require different approach towards their revenue management or tax management. And guys, just have a look at these items, okay, yourself. Just take a pause and have a look at these items. Broadly you should be knowing that which item is categorized under which tax rate. So this was all a bit of some important information. To download the PDF, subscribe to this channel. Simply download the Telegram app. That is a you can say it is not as distractionary as Facebook or other apps or WhatsApp even. So you can simply subscribe to this channel. Simply by searching Study Maniac, you can search for my Telegram channel, where I share all the PDFs, other information, important editorials, etc. Then this is the Facebook profile, where I keep on sharing the PDFs for the books. Like yesterday I shared this India Since Independence, and even 2-3 days back Plassey to Partition, and I'll be sharing more books over there. So you can follow me on my Facebook profile. Then coming to this YouTube channel, please subscribe to this YouTube channel, so that as and when I upload some new video onto this channel, you are able to get the alerts regarding that. And do give a like if you are liking my content, and dislike, and also a reason in the comment section below this video as to what else you want in that. And these are the direct links provided for the Telegram channel in case you want to access it through the desktop or laptop, right? So this was all, and very soon we will be coming up with the editorials from this magazine Frontline, okay, related to the 70 years of independence and other things, and also on right to privacy. So Frontline articles, you can read them on your own as well, but the point is they are very critical of the government functioning. So I would try my level best to present to you a balanced view, right? So balancing the two sides, left and right, we will be having a neutral viewpoint towards the thing as is required by the by our exam, for our examination purpose. So this was all, guys, and you can subscribe this channel, and this Frontline editorials I have mentioned over here. Thank you, have a nice time, and please follow up with the Yojana MCQ video also. It is available now. You can, in English language also it is available, and PDF for same will be available on the Telegram channel. Thank you, bye bye.